they're thinking about. Do I have a job? Do I not have a job? Am I getting equity? Am I not getting equity? Or are they thinking about portfolio? What stock do I pick? So we look at changes in ownership, professional staff turnover, changes to investment process, because if the process changes, past performance is not that useful an evaluation tool. Changes in asset under management, because that helps us assess the business strength of the firm and whether they're under organizational stress. So this gets tracked all the time. We're doing this on your behalf so you can focus on the client relationship. Rebalancing is also a big deal. That goes to staying on target, and we've got a little chart in here to illustrate it. We started in '97 with a 50-50 portfolio. In August 2000, it was almost 60-40 if you didn't rebalance. Then you were too long stocks and stocks went down. Vice versa, when stocks are at the bottom, it's now at 40-60. Rebalancing helps smooth this out and actually let you capture the mean reversion process a little bit in the returns. And as you can see in December 2008, when Treasury bonds went through the roof, what happened? And that's when you should have been selling your Treasury bonds in the first quarter. Finally, tax-aware implementation. We have an illustration here to help your client understand the impact of taxes. And we create two sets of portfolios, and I'll get into that in a minute, that are designed for either tax-deferred or taxable accounts. Muni bonds obviously go in a taxable account, but we also utilize index funds and low turnover funds to help reduce the tax cost drag on your taxable accounts. Already talked about FDX advisors, but here's a slide in there for that. And what you have are, as Ryan indicated, conservative to aggressive growth portfolios. We don't go below 30% equity. We figure if you're going to go down that low, you're probably going to want to do something specific with the fixed income, and minimums get in the way when your equity portfolios get too low. The flip side of that is if you're doing something special with the fixed income, we're giving you an all-equity portfolio so you can blend those together. Principles are summarized here in the back, and the fund selections are also listed in the back. And we're showing it for taxable accounts and tax-deferred accounts. So you can see, for example, we have an index fund in here on the tax-deferred, taxable accounts to keep tax costs down. We also pay close attention to expense ratios. Here's a summary of expense ratios of the underlying funds, the weighted average expense ratios using current selections and allocations. You can see for the taxable accounts, we're about 80 basis points for the all-equity portfolio, when we get down to the 50s for the conservative portfolio. And for the tax-deferred accounts, we're around between 90 and 105, 106. And that's a function of which active managers we're choosing in the equity space, obviously, the higher the fee there. But when you look at that, it's competitive with mutual fund expense ratios generally. Let's move to a fact sheet. This is a fact sheet. Again, it's produced each quarter and updated. We provide a little risk meter. So this is the moderate growth allocation. It's 65% equity. I'm going to widen this so you can actually see it. And what you see over on this side, how do I get rid of this thing? What you see over on this side is performance statistics. So you can see this group of funds that had you invested in them over the last decade would have outperformed by 2.4%. Shows the difference in standard deviation and beta, and risk-reward ratios, upside and downside capture. We show the actual holdings, the allocations to the holdings. Again, the principles are summarized. second page goes into a little more detail about equity composite, fixed income composite, regional allocation, sector allocation, minimum investment, and the weighted average expense ratio. So that is part of the marketing collateral. In addition to that, we publish, and you can, we send these out to our clients, our institutional clients. We call them FDX Advisor Notes. They come out quarterly generally, and for example, this one came out in April. They're also on our website, foliodx.com. It came out in April basically saying it looked at all the bear markets since the Great Depression, put this one in context, and essentially made a case that it was time to buy. The market the market was trading here like we were in a Great Depression, and we weren't. We in fact had money growing very rapidly. Unemployment wasn't nearly as bad as it was in the Great Depression. Here's your money growth now versus negative money growth then. The Fed made mistakes back then. This one looked at what happened in 2008 in more detail and made a case for why a better way to diversify. This one looked at credit spreads back in January and basically said buy credits. So these are available to you as well. What else can I tell you? What's in that cover, Ryan?
Oh, I think that was pretty good. It's even better the 10th time I've heard it. It gets better and better. Where would they sign up for advisor notes? Is there a place to sign up?
Well, if they want to actually get it direct, they need to send an email to
I mean, I could just, if you want, guys and gals on the line, if you want to send me an email saying you want to receive this, I could send Ron an email to add you to a list. Would that work? Or you could, well, there you go, advisor.notes@foliodx.com.
Right. That's it.
Good. Take me out of the loop.
Right. You send it there. That gets monitored, and you get added to the distribution list. And when it comes out, the next one that comes out, you'd be on.
I do want to go back and, for any of our late arrivals, go back and talk about the marketing material and account opening documents. Again, before I do that, I wanted to reiterate some of Ron's comments about how scalable this program can be and how attractive it can be to all types of clients. Those that meet the $30,000 account minimum, those that meet the $50,000 account minimum, and up to $150,000. So it can be scalable based on the if you want to use money as a gauge for sophistication, based on sophistication of your clients and prospects.
Yeah, and it's going to go further than that, actually, Ryan. When we go to the UMA accounts, we anticipate. You say you get up to a $500,000 account. We anticipate blending multi-manager, unified managed account portfolios, model-based portfolios, using the same principles here, with some mutual funds that are better used for the extended asset classes such as emerging markets. So we'll have a hybrid, and again, it'll be the same principles up and down your client base. So what that means is, I think I mentioned this again. You got $1 million client or a $10 million client, and they bring you their nephew or their son-in-law that's just getting started with his 50 grand. You can basically deliver the message on giving them the same investment process. The selections have changed because he's got less assets. I can't diversify as much and go into those extended asset classes. Same process, however, same principles. So we think it's a story that resonates.
And we at Kovac agree. To Ron's point, we have accounts that are $30,000, as he said. We have accounts that are $500,000 currently. So right now, our average account size is roughly $136,000. So it does it does show you right there.